Thank you for standing by, and welcome to the Costa Group Holdings Limited first quarter fiscal year 2021 results call. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Sean Hallahan, MD and CEO. Please go ahead.
Good morning, ladies and gentlemen. And slight correction to the introduction there. Welcome to the Costa Group Holdings results presentation for the half year CY21. I'd like to open with an acknowledgement of country. We acknowledge the traditional owners of the land on which we work, grow and live, and recognise their continuing connection to land, water and culture. We pay respect to elders past, present and emerging. My name is Sean Hallahan and I'm the CEO and Managing Director of Costa. Joining me in this presentation is Wayne Johnston, Costa's Chief Financial Officer. I'd like to begin with key highlights covering the first half. First, consistent with the advice we provided at the announcement of the 2PH acquisition and capital raise in late June, we achieved our half-year forecast earnings with an EBITDA total of $124.4 million and NPAT-S of $44.4 million. As many of you are aware, the majority of our international segments berry harvests in Morocco and China occur in the first half of the year, and pleasingly the segment delivered a record result with 25% revenue growth versus the first half CY20. The performance of our domestic segment was mixed, and I will talk in more detail about this shortly. Our balance sheet remains strong, and throughout we've maintained a relentless focus on COVID-19 to ensure we met our labour needs. As mentioned, in late June we announced the acquisition of the 2PH citrus business, accompanied by a capital raise, which successfully raised $190 million. The acquisition was completed on the 19th of July. Moving on to key messages for the half. The strong performance of our international segment saw positive pricing, yield and demand maintained over the entire China season, reflecting an increased production footprint and demand for our high-quality products. In Morocco, there was favourable earlier fruit timing and stronger pricing, which was supported by increased contribution from our expanded southern plantings in Agadir. Domestic produce segment performance was mixed across the categories, and as previously flagged, the avocado result was impacted by sustained higher industry volumes and Costa's own production volumes over the entire half. This resulted in below price expectations. It should also be noted that a contraction in food service channel activity also affected demand. The performance of our berry category was improved compared to first half CY20. Corindi, New South Wales raspberry production returned to normal and there was generally favourable pricing across our 4 berry varieties. The New Year's Day 21 Calignan hailstorm progressively impacted over the half, as initial table grape crop damage estimates deteriorated as the season wore on. This had a significant impact on the Calignan's table grape yield and also resulted in reduced citrus yield. Positively, the company successfully acquired a number of key citrus assets over the period, including the aforementioned 2PH in Central Queensland and KW Orchards in Sunraysia. This increases total citrus group revenue contribution, further opens export market opportunities, expands our production footprint and gains preferential access to a proprietary breeding program. The full season earnings impact for both acquisitions will commence from CY22. With respect to our growth plan objectives, these continue to remain on track to drive revenue, increase yield, create production efficiencies and stimulate innovation. Our growth plan includes the construction of our new 10 hectares of tomato glasshouse and 2.5 hectare nursery, which will be completed on schedule in CY21. In our international segment, further China expansion is occurring, with an additional 50 hectares of blueberries planted and delivering increased yield in CY22. Excuse me. The commercialisation of the previously announced 40 hectares of protected substrate avocado cropping is on schedule, with preliminary planting to commence late CY21, with first harvested crop expected from CY23/24. Moving to the financial headlines. Revenue over the half was $612.4 million, with EBITDA of $124.4 million, a 4.3% increase on first half CY20. NPAT-S was 44.4 million, 3% growth on first half CY20, and statutory NPAT was 37.5 million. Net debt was 208 million, a 44.6% increase on December 20, resulting in leverage of 1.4 times. Finally, a fully franked dividend of 4 cents per share will be paid. COVID-19, of course, remains an ever-present risk, and it is important that we update the market on how we're managing this risk. With regard to labour, we continue to effectively deal with border closures and ongoing travel restrictions. We successfully met our first half workforce requirements, including sourcing of sufficient people for the citrus season across multiple growing regions. As previously flagged, there were some short-term constraints at Monarto. Importantly, the promotion of local employment through a targeted social media recruitment campaign will continue to be a focus across the categories going into the second half, and we expect to meet all labour requirements over the period. Maintaining a vigilant approach to health and safety is also a key focus, and we continue to have in place a comprehensive COVID-19 action plan. In recognition of the public health priority and Costa's food production status as an essential industry, the company is encouraging staff to be vaccinated and assisting them with the flexibility to do so. Given our large regional footprint, we're also focused on working with the communities in which we operate to keep them safe and healthy. From an operations perspective, we're committed to maintaining uninterrupted production and supply to our customers, despite rolling lockdowns in Victoria and New South Wales and any retailer DC impacts. There were significant supply side challenges in the first half, including availability of shipping freight, but these were all successfully managed. As with the general global COVID-19 situation, circumstances in Morocco and China remain fluid. However, appropriate protocols are in place to manage this as we enter the second half of the year where labour needs are reduced. In the first half, COVID-19 related expenditure amounted to circa $2.5 million, with travel and quarantine accommodation for seasonal workers making up the bulk of these costs. Other expenses included PPE, cleaning and sanitising. At this stage, we are forecasting a likely similar range of costs to continue into the second half. Over recent years, the company has made sustainable commercial farming integral to our operations and growth strategy. Current practical examples of this include investment in the commercialisation of protected avocado cropping, the further geographical expansion of our citrus production footprint, the progression of our VIP berry breeding program to develop tropical and subtropical varieties, and the reporting of detailed metrics as they relate to our environmental performance, including water usage. These investments are all targeted at addressing climate-related financial risk, but they also seek to capitalise on a number of other positive opportunities, including improved yield efficiencies through innovation in growing techniques. Costa will continue to develop our sustainability reporting and strive to be a leader in establishing benchmarks for the global agricultural industry. In our 2020 sustainability report, we further progressed our adoption of the Task Force on Climate-Related Financial Disclosure, or TCFD, and we committed to a number of United Nations Development Goals that we believe are reflective of and complement our own sustainable commercial farming principles. Our aim in CY22 is to establish quantitative targets and further develop our reporting of key metrics as they relate to energy consumption, water use and waste. Moving on to performance by segment and beginning with international. As mentioned in my introduction, the international segment achieved a record result with strong sales and EBITDA-S growth. Central to this was the further development and market penetration of our premium blueberry varieties and genetics across multiple regions. To summarise, our China operations saw an increased production footprint driving our ongoing growth strategy, including a pleasing first crop from the new Guangmen farm plantings of 67 hectares. There was also a pricing advantage throughout the season from premiumisation, early COVID concerns on imported fruit, and a disrupted South American export season. These factors all contributed to a significant overall improvement in sales and earnings. In Morocco, the increased contribution from the southern plantings at Agadir resulted in high yields supported by favourable timing. Combined own and third-party grower plantings in Africa amounted to an aggregate increase of 1,456 tonnes production, equating to 19% higher versus the PCP. Now looking at both China and Morocco in more detail. In China, there were higher volumes from increased plantings and lower imports of South American fruit into the market, especially earlier in the year, which supported strong pricing and demand over the season. Total volume by tonnage was an increase of 1,093 tonnes versus PCP. The overall yield finished in line with expectations, with jumbo Arana variety volumes higher than budgeted towards the end of the season. Pleasingly, our premium varieties, including Arana, have gained further market recognition and continue to attract a significant price premium. This supports the continuing development of our China farming footprint. Early season plantings in Agadir, as well as earlier season higher volumes across our northern farms, together with strong pricing over the season, contributed to the very positive result. The Moroccan performance also benefited from delayed timing of the main Spanish blueberry season by 3 weeks. Looking ahead, there is an accelerated focus on the scheduled replanting at our northern farms, which includes the replacement of legacy varieties with new premium Costa varieties, which will result in a short-term volume decrease versus PCP. I also want to touch on our genetics licensing activity, which from this point on we will refer to as emerging regions, which we feel more accurately reflects the emerging opportunities that exist for Costa to not only expand our genetics licensing footprint, but potentially also our own production footprint. With respect to licensing activity, there was increased activity in Africa over the half, where third-party grower tonnage was 148 tonnes more than versus PCP. Our blueberry varieties are being grown by licensed third parties in Zimbabwe and South Africa, which have both seen a positive early start to the season. Planted hectares in these regions are continuing to increase, further building on the 52-week supply volumes out of Africa, which we market into Europe and Asian markets. Costa also signed a new long-term exclusive agreement in late CY20 with Driscoll's for licensing of Costa blueberry genetics in the Americas. This reflects how our international licensing program continues to build in importance, including expanding geographical reach across Africa, China, and the Americas. This is in recognition of our superior blueberry genetics and consumer demand for premium quality fresh produce. Moving on to our domestic produce segment. It was a mixed performance across the categories, resulting in lower revenue and reduced EBITDAS versus PCP. In summary, although demand was strong overall for mushrooms, there was a small decline in revenue versus the prior comparative period, primarily due to inconsistent Monarto volumes. Berry revenue was up on PCP due to Corindi raspberry volume returning to normal versus PCP drought impacts. There was also favourable pricing across our 4 berry varieties. In tomatoes, volumes and pricing were down versus PCP due to less than optimal growing conditions and increased field and truss supply. The hailstorm, which significantly impacted the Calignan Sunraysia table grape crop yield in particular, and also resulted in reduced citrus yield, had a negative revenue impact of circa $25 million versus PCP. Finally, although avocado revenue was up versus PCP, this reflected greater volume, with pricing significantly below prior year. Now talking to the performance of the produce segment in more detail, and starting with the mushroom category. As previously noted, short-term labour constraints at the Monarto facility contributed to inconsistent volumes over the half. Demand conditions were strong, particularly going into the winter months, reflected in favourable retail and wholesale pricing. The full benefit was not able to be realised due to the inconsistent production volumes. Pre-packed products made up 56% of total sales, reflecting still strong consumer preference over loose during COVID-19. Sourcing and retention of labour continues to be a key priority. Monarto harvest worker numbers have increased over recent weeks, and this has contributed to higher harvested volumes. In the berry category, the Corindi raspberry crop returned to normal after the prior period drought impact, There was generally favourable pricing across the four main berry varieties over the half, and this was ultimately in line with expectations. Blueberry pricing was ultimately impacted by some quality issues. There was a stronger finish than usual to the Tasmanian season. However, overall volumes were down due to climatic conditions versus prior period and shortage of labour during peak harvest periods. The early Far North Queensland Orana variety volumes attracted a 23% price premium. However, overall yield was lower than forecast. The Western Australian berry crop was impacted by weather, resulting in a 64-tonne shortfall against forecast. There was a relatively slow start to the main Corindi New South Wales season due to weather, with majority of crop to be completed over the second half. Moving to the avocado category, as previously noted, sustained higher volumes contributed to significantly lower pricing and category performance. COVID-19 further contributed to food service sector contraction. Costa volumes were up 15.2% versus the prior period, with industry volumes up circa 50%. Third-party marketed trays were a positive 11.4%. The Western Australian avocado crop volumes are strong, and this will further contribute to higher avocado supply and lower prices. At present, the estimated production for the WA season is circa 9 million trays. On a more positive note, avocado export activity has been positive year to date, circa 86,000 trays as at the end of August, with volumes already exceeding CY20 export volumes, but coming off a low base. The tomato category saw increased field tomato and truss supply impact short-term pricing across all varieties, particularly truss and to a lesser extent snacking and cocktail. This resulted in a negative pricing impact in the range of 30 to 60%. Volumes were down over the half due to poorer growing conditions, caused mainly by lower than normal light over the summer months and a shortfall in sourcing quality truss from external growers. This resulted in a circa 4% reduction in yield, own and third party, versus prior period. We are forecasting yield improvements over the second half and anticipating reduced reliance on external grower volumes going forward once our new glasshouse fully comes online in CY22. In the citrus segment, the impact of the previously advised New Year's Day 21 hailstorm damage to our Calignan Victoria table grape crop progressively increased, resulting in significantly lower production volumes from this farm and a subsequent negative earnings impact. The early citrus season harvest through May and June delivered tonnage ahead of forecast, due primarily to early timing of the mandarin harvest. However, the Riverland fruit fly restrictions imposed earlier in the year have added additional costs. The restrictions, which required cold treatment for the majority of our products, will be in place for the remainder of season. This situation is being well managed, with the expected cost over the season to be somewhere in the range of $6 to $8 million. The Riverland yield has been tracking close to forecast, with fruit quality above expectation and percentage of first-grade fruit being packed ahead of same time versus prior year. While the 2PH season has progressed positively, with favourable pricing in all export markets, especially China. 2PH branded product is attracting a price premium above competing citrus brands in the Guangzhou and Shanghai wholesale markets. I now hand over to Wayne Johnston to talk to the group financials.
Thanks, Sean, and good morning to everyone on this call. Before we move into the group financial slides, as highlighted in previous results calls, the company is now reporting the financial results on a post-adoption of the leasing standard WASB 16. The results are presented including normalisation for SGARA accounting and material items relating to the various acquisitions in the period. Additionally, we have disclosed the international segment and consolidated group results, including new disclosures in relation to prior half-year period being restated for constant currency movements. This is due to the significant weakening of Australian dollars in the first half of CY20 relative to this year. Future disclosure of this additional analysis will be subject to whether material differences in rates have occurred in the period. As Sean has already covered the various segment performance, I will briefly concentrate on the consolidated group results. Revenue for the 6 months ending 27 June was $612 million. This result was flat with PCP, although represented a mixed result between the two largest segments in the group. The international segment recorded a revenue increase of 25% over prior period. The result was also 36% above last year in constant currency. China and Morocco benefited from increased footprint and pricing advantages. Conversely, the produce segment was down nearly 25% versus last year, with the variance largely explained by the impact of the storm damage at our Sunraysia citrus property in January, as Sean explained. EBITDA before Zagara and material items was up 4% or $5.1 million versus last year. As highlighted today, the strong first half result from the international businesses was largely offset by the underperformance versus prior period of the domestic produce segment. Given significant growth projects in the last 24 months, amortisation and depreciation expense increased versus prior by 2% to $50.3 million. Further increases in the second half of this calendar year are expected given the rollout and finalisation of various capital projects. Interest expense of $11.6 million was $2 million below last year. This benefit was largely driven by lower base rates and lower average debt given a reduction in debt levels throughout the last 12 months. I will discuss cash flow performance shortly. Similar to prior years, tax expense of $7 million was for the group represents a relatively low effective tax rate of only 12%. The group continues to receive the benefit of tax concessions in both China and Morocco for agricultural companies. Based on our full year guidance, I would expect a similar dollar value of tax expense in the second half. Net profit before Zagara and material items of $44.4 million represented an improvement over last year of 3%. We reported $2.1 million of material items in the half. These represent costs incurred in the period relating to the acquisitions of the three businesses we've acquired during this year. Stamp duty is the largest individual cost. Given the 2PH and Select Fresh acquisitions completed in July, the second half will include additional material item costs of approximately $15 million. Stamp duty is also the largest individual item in the second half. In relation to the cash flow for the year, I'm pleased to report another outstanding result for the half year, with all categories within the group performing exceptionally well. Free cash flow for the year of $49.5 million was an improvement over the prior year. A working capital outflow of $23.5 million is consistent with the working capital seasonality of the group, given the timing of the various harvest periods. As disclosed on the slide, we are expecting a strong second half, given the normal patterns of the group, and additional inflows from the remainder of the season for the recently acquired 2PH business. Included in the working capital movements was tax payments of $12.9 million, which, as per previous guidance, were above prior year levels given higher earnings in CY20. I would expect the second half to be approximately half the amount of the first half payments. Operating capex of $18.5 million was above prior period, but more in line with our normal run rate, given the prior year was impacted by deliberate slowdown of capital projects at a time when the first impacts of COVID were impacting the world. Second half payments are estimated to be approximately $25 million. Growth capex of $33.3 million was slightly above last year, but in line with expectations. Major projects include the near finalisation of Glasshouse 4 in Zyra, commencement of the avocado trellis project, and a small number of asset acquisitions in citrus. The second half will be a busy period as we close out Glasshouse 4 and recommence the international expansion projects now that the annual harvest period is finished. Overall, we expect approximately $55 million of outflows relating to these various projects. Of course, we also see the impact of the acquisition of the 2PH and Select Fresh that both settled in July. Payments of approximately $235 million were made in July for these deals. As discussed earlier, we primarily funded these acquisitions with a successful equity raise of $190 million. Briefly with regard to the balance sheet, I'm pleased to report that the balance sheet remains in a strong position. The increase in working capital investment of $12 million reflects the previous slide discussion on the seasonality of the group. Net debt increased to $208 million in the half, was largely driven by an on-balance sheet funding of the KW Orchids acquisition and the working capital investment. As discussed, net debt increased by $64 million, but key metrics continue to represent a strong balance sheet position. A leverage ratio of 1.4 times is well within the company's target levels of 1.5 to 2 times. Interest cover ratio has improved 3.1 points since this time last year to 8.9 times. During the period, the company extended the largest tranche of the Australian syndicated facility for another 12 months to give senior debt maturity of at least 24 months at that balance date. I'd like to thank our syndicated banks for their continued support to the company. Our international business utilised local facilities to fund not only the harvest period but also to support growth CapEx. We continue to have strong banking relationships in both China and Morocco that are supporting our exciting growth plans. As discussed, the company declared a fully franked 4 cents per share interim dividend. Whilst in line with PCP, the overall cash commitment to the dividend is up 16% given the recent issue of new shares in the July equity raise. I'll now pass back to Sean for business and growth plan updates.
Thank you, Wayne. I now move on to an update on our recent ESG activities and organisational structure update. In June 21, Costa published its first modern slavery statement, and this outlines the extensive steps we have taken to understand, mitigate and address human rights and modern slavery risks within our operations and supply chain. One of the key tools we use to address modern slavery is through our ethical sourcing program, which has been in place since 2019. This includes the use of SEDEX as a management tool to help the company understand the level and scope of social sustainability practices across our own sites and within our partner grower base. We also have in place a strong governance approach to modern slavery, with board and executive oversight and the operation of a modern slavery working group. As part of our ongoing focus on pursuing competitive advantage, we have combined our mushroom and tomato categories to form a new vertical farming category, and also combined our avocado and citrus categories to form a new trees and vines category. These categories share many common production and post-harvest practices, and there are natural synergies, particularly in relation to supply chain, sales and marketing, and production. For the purposes of ongoing reporting, we will continue to provide information based on the produce lines of mushroom, tomato, citrus and avocado. Over the period, we also made new executive appointments, adding the roles of Chief Marketing Officer, CMO, and Group Manager, Risk and Internal Insurance. The CMO will focus on category brand development and will also lead our food safety and consumer insights team. The Group Manager, Risk and Internal Assurance role is responsible for the enterprise risk management program and internal audit activities. I now move on to our growth plan update. And as mentioned, there has been a lot of activity in the citrus space. The 2PH acquisition will deliver a number of key benefits for the business, including greater export supply to key Asian markets, increased citrus category group revenue contribution from approximately 30% to 35% post-transaction, exclusive rights to selected proprietary varieties, including a proven 30-year proprietary breeding program, and extended variety and early season timing, with the 2PH season commencing in mid-March, making it the earliest citrus season in Australia. The final 2PH capital cost was $220 million, which was partially funded by a successful capital raise of $190 million, completed at the end of July. The initial cost was above that which was previously announced due to timing on working capital on settlement and owing to earlier completion than expected. The sale agreement includes the economic and cash flow benefit of the CY21 season, although the majority of earnings are accounted for as balance sheet rather than CY21 P&L. I also note that the pro forma CY21 EBITDA-S contribution would have been $29 million if the 2PH asset had been owned for the full year CY21. With respect to a season update, the forecast volume is circa 30,000 tonnes, with the season largely performing as expected. Export pricing has been in line with expectations, and there has been no disruption in access to the Chinese market to date. There's also been some positive news on market access. Just last week, the United States gave the green light to market access for the export of citrus grown in central Queensland, further opening potential markets for our 2PH volumes. During the half year, we also completed the acquisition of KW Orchards and Kufari Farms. These farms provide the benefits of expanding our citrus sunraysia footprint, providing an attractive varietal mix suited to the export market, and will play an important role in our capacity to take further advantage of strong citrus export demand. The 2PH, KW Orchard and Kufari acquisitions increased Costa's total citrus plantings by over 60% to 4,348 hectares, farming locations now to 11 and major growing regions to 3. Our 10-hectare glasshouse and 2.5-hectare nursery project at Guyra, New South Wales, has proceeded to schedule. The full commissioning of the glasshouse and nursery will be completed on schedule by the end of August 21. The nursery build was completed as at the end of July. Planting has commenced across 5 hectares, with the first initial production prior to start of CY22 and volumes to ramp up in the first half of CY22. These builds have utilised world-leading technology to ensure water self-sufficiency and energy consumption. Quad generation gas power system has now been installed. This is used to generate our own power, heat and CO2 for the glasshouses. The CO2 is utilised by the plants for photosynthesis during daytime, and the use of the quad generation system should also result in reduced operational costs versus the separate purchase of electricity, heat, cooling and carbon dioxide. As announced at our CY20 full-year presentation, the Costa board approved the commercialisation of protected, trellised, high-density substrate avocado trees across a number of regions aligned to existing avocado plantings. The benefits have already been apparent in the earlier trial plantings, and these include production costs significantly less than standard orchard plantings, faster tree maturity, higher yield, better fruit quality and greater efficiency of water use versus conventional plantings. The first harvested crop is expected from CY23-24, and the forecast harvest from 40 hectares at full maturity is circa 300,000 trays, compared to 115,000 trays from a conventional in-soil unprotected crop. Moving to an update on our international growth plan. In Morocco, a further 14 hectares will be planted at Agadir in November 21, taking total plantings in this region to circa 102 hectares. As already touched on, a progressive replanting program of our northern farms is scheduled to commence the second half of CY21, with planting of Costa VIP, purpose-bred, superior genetic blueberry varieties. This will lead to a reduced yield impact in CY22 of circa 430 tonnes. In China, our Baoshan CY21 development planting of 50 hectares of blueberries has been completed and is on schedule to deliver first crop in CY22. The CY22 Baoshan development of 100 hectares is progressing, with work commenced on the installation of protective tunnels and irrigation and substrate materials. Plant supply confirmed for a CY22 planting. Lastly, we finish with the outlook for the remainder of CY21. Firstly, our full-year forecast is confirmed in line with our 2PH capital raise disclosure. CY21 EBITDA-S and NPAT-S will be marginally ahead of CY20, excluding any contribution from 2PH. There is significant domestic activity still to occur over the second half, with positive momentum driving the remainder of the citrus season and the main berry season expected to deliver healthy growth versus PCP. Citrus yields and quality are in line with expectations across our growing regions. Demand from North Asian export markets, Japan, China and Korea, is strong going into the second half. Some COVID-19 supply chain issues are contributing to a challenging demand situation for the remainder of the season into Southeast Asian markets. There has been positive berry pricing due to fluctuating blueberry industry volumes as a result of poor weather causing delays to Corindi, New South Wales crop timing, including Arana. However, the overall berry crop is expected to meet expectation. We expect continuing favourable mushroom demand and pricing, presenting a positive opportunity once volume consistency improves. Short-term labour supply challenges have been addressed at the Monarto mushroom facility. The new glasshouse planting is continuing to proceed as scheduled with no anticipated delay. Light issues that have affected growing conditions will improve over the second half as we move into the spring-summer months with improving volumes. Finally, as previously flagged, the high Western Australian avocado season volumes will contribute to continued depressed pricing over the second half. Ladies and gentlemen, that concludes Costa Group's half-year CY21 result presentation, and I now invite any questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you are on a speakerphone, please pick up your handset before pressing the keys. And the first question comes from Michael Peet with Goldman Sachs. Please go ahead.
Morning, Sean and Wayne. Thanks for taking the question. And look, thank you for the extra disclosure there with tonnages and things and changes. That's pretty useful. And the impacts on revenue were interesting as well. Look, just with mushrooms in mind, therefore, I just wonder if you could quantify maybe what the impact has been from lost revenue as a result of the issues at Monarto and how you've managed that through the different customer channels.
Yeah, hi. Good morning, Michael. Michael, I think thanks for the thank you, if you like, on the increased disclosure around tonnage. I think what we're really keen to do now is just keep to this form of reporting, and we will also obviously show this again in the second half, so you'll have a good comparison over the full year. So not keen to break it any further down in terms of mushrooms, but suffice it to say, we've been clear before that Monarto is not operating at full capacity, and so you can see there that we're just slightly off the prior period where normally we would have expected some growth based around that facility. As you also know, it's our most cost-competitive facility by far, and so therefore losing any tonnage and revenue from that impacts us significantly. Pleasingly, though, from a retail demand, which, as you know, is the majority of our business, retail demand's been exceptionally strong. We've been happy with numbers of our tonnage, sort of circa 85 to 90% have been going into retail. And I think we also called out the pre-packed volumes at a really healthy percentage as well of about 56%. So all up, the backdrop is good for us in mushrooms. We just need to get more consistent from all of our facilities, and we'd look forward to increased contribution.
Just on the citrus category, could you update us just how much more harvest is to come into the second half, and also maybe an update on how export pricing is looking?
Yeah, so I'll take the latter first. So export pricing has remained pretty steady for us. It's in line with expectation. North sort of Asia, particularly strong as we called out. Southeast Asia, a little bit more challenging. Certainly from a shipping container and logistics point of view, as is no surprise to anyone on this call, it's being felt across a variety of industries, and we've had to manage through those challenges as well. But so far, we've done that very well. We're about just under 60% of the overall harvest for us at the moment from a Riverland and Sunraysia point of view. Of course, that won't exactly match up with these first half results that you've got, because I'm talking year to date, if you like, but still significant proportion of the crop to come.
Just final question from me, just the genetics licensing revenue fell 11.4. Is that anything to do with the new agreement with Driscoll's, or is there some timing issues? I'm just wondering what's happening there.
Yeah, no, as per the comment, I think we tried to call out, it's just a timing issue, and if you work out the quantum of it, it's not very material at all, but you're right, the minus 11% stands out, but it's just timing.
Great, thanks, Sean.
Thanks, Mike.
The next question comes from Larry Gandler with Credit Suisse. Please go ahead.
Hi, guys. Again, thanks for the disclosure. Acknowledged and useful. Can I ask a question, Sean, on citrus? So a couple of acquisitions, obviously 2PH and Kufari, I think is how you say it.
Yep.
I'm just wondering, as you look at your portfolio now in citrus, is there any area that, whether it's geography or maybe product class, that you feel you need to build out?
Yeah, no, thanks for the question, Larry. Look, I think that we remain acquisitive in this space without a doubt. As we've said before, Australian citrus occupies a niche, high premium area, and total Australian citrus is only about 1% of the global citrus market. We're right on the doorstep of Asia, as you know, and you know, we command a premium based on that positioning. I think now for Costa, we'll only be circa 30% of total Australian citrus exports, so we certainly see room to grow. The barrier, if you like, to growth is just the availability of the right high quality assets, crucially with the right varietal mix suitable for overseas markets, and plainly water security is always a key deliberation point as well. So we think about each of the three regions. I think we're about 50% of the riverland as we sit here now. We have a well-defined watch list of properties that we'd be interested in, but that's not something we can influence really the timing of when they come on. From Sunraysia, we're now up to about 700 hectares. We've announced that we will be building a new greenfield high technology pack shed in that area. The 700 hectares will support that, but plainly we'd be on a growth path to further support it. And then if you think about 2PH and that sort of Queensland region where we are, we could be interested in some bolt-ons there, but I think our initial estimation is there's not really many properties that look like they would meet our criteria around that region. So I think out of it all, the summary would be Sunraysia is probably the area that we see the most domestic growth in.
Okay, great. And I know this question may be looking perhaps too far in advance, but I think we've had some conversations around this before. Mushroom demand remains strong, especially COVID, and as you get Monarto up, do we need to start looking towards increasing capacity in mushrooms, or do you have ample capacity even after closing 2 facilities?
Yeah, no, it's a good question, Larry, and you're right. We have talked it before. Look, I think fundamentally, and we've been very open with this, we haven't achieved exactly the type of production that we would like, the consistency that we would like out of Monarto. So it's hard to judge the future space. Well, what I would say is that we do like being in a strong market position in mushrooms, and we'd always want to continue that. I think bringing mushrooms and tomatoes together as vertical farming is going to help narrow our focus on what it's really going to take to succeed. Obviously, both divisions are primarily or are entirely domestic focused. And so for us, really, it's about being a low-cost producer, like a consistent, high-quality, low-cost producer. And I think there's work that we can improve on for both of them. And also the growth as we see it, you know, both businesses are primarily about the major retail channel, plainly food service, and in particular emerging areas like e-commerce and meal kit growth are segments that we already have reasonable presence in, but we'd like to continue our growth into those areas. And I think the recent acquisition of Select Fresh WA sort of points to that future direction as well.
Okay, yeah, that helps. Thanks, Sean.
The next question comes from Jason Palmer with Taylor Collison. Please go ahead.
Good morning, Wayne and Sean. Thanks for your time.
Good morning, Jason.
Just a couple of questions from me, please, if I could. Just in respect to that international segment, and I apologise if this has already been covered. I just joined the call late. The pricing growth that you obviously achieved was phenomenal across both Morocco and China, and you've called out the reasons for that. As you look forward into next year, are you able to sort of talk about that sort of pricing tailwind becoming potentially a headwind and how that might offset against the broader challenges you've seen this year in the domestic produce business, please?
No, thanks, Jason. Look, I think, as you well know, pricing in produce, whether it's domestic or international, resets itself each year based on available supply. Well, what we've been very clear about is we do believe we got some tailwinds internationally in this first half. We had a Chilean season that ended a bit more abruptly and with less volume than might normally be the case, and we had a Peruvian season that came in late and was probably down a bit as well. We also had, if you remember, some COVID scares around imported cherries into China, which no doubt supported our own domestically grown blueberries in China. Be all that as it may, our actual own yield performance we were really happy about, and we've disclosed those numbers for you now in terms of production volumes, and I think that the team performed really well with a very challenging backdrop. Do I think it's all going to be as good for the next year? I mean, we can't talk for what will happen with Chile and Peru. The other thing I would say is that the jumbo varieties, they call it in China, continues to attract a really strong premium to the market. So wherever the normal average blueberry price goes, if you like, our normal blueberry varieties get a premium to that, and then jumbo gets a premium on top of that. So I think all of that speaks pretty well to our international growth strategy, and as you point out, it certainly helped offset a bit of softness in the domestic category this year. Looking forward, certainly I'd hope that some of the things that we've seen in domestic are going to correct for next year, and I'd hope that international will have another really strong result.
Okay. All right, thanks for that. But you're not going to do a bridge at all for us on sort of what the main drivers to the domestic season were in absolute terms. Is that what you're saying?
No, I think we've given now the volumes and the tonnages by category, which we haven't done before. We'll repeat that again, obviously, at the end of the year, comparing second half to prior period. And then, as always, with questions and commentary, we'll attempt to explain the narrative as best we can, Jason. I think that's a substantial shift from where we were before. Okay, yeah, and I acknowledge that. And so if I could ask just another question in respect that before I go on to the other one, it was just when you look at that hail impact of 25 million you've called out, I mean, obviously there's a large portion of fixed costs in that business and a smaller portion of variable costs, and maybe it's 2/3 fixed versus 1/3 variable. Is it fair to assume that hail damage was north of $10 million EBITDA impact to the group? And see, here we go, Jason. we give one level of quantitative, and then we get led into other areas. So okay. You'll have to make your own calculations. But you're right, it's a high fixed cost business, as you well know, and that revenue impact through the hailstorm was definitely material. Okay, and I'll move on. Just the other question I had was in respect to the outlook. Just in general, your assumptions around citrus and berry pricing, are they that they hold at current levels in all markets that you're currently seeing, or is it that they temper somewhat? Okay, good question. So we called out in CY20 that we thought domestic citrus pricing was elevated because there was a poor southeast Queensland season and a poor WA season, and we wouldn't expect that pricing to continue in 21. That's basically turned out to be the case. As you well know, most of our citrus revenue, though, is export. And I think for the last 3 years in a row, we've said export pricing and demand has remained relatively strong. And we like the business very much because we have a very broad customer base. And according to the quality of the crop that we're bringing to market and how much first-grade fruit there is versus other types of grade fruit, we've always got a willing home. We always have more orders for our citrus crop than we can fulfill. And that still holds true. So that plainly helps us from that pricing point of view. With regard to berry, I think we've talked through the international side. Domestically, it's been a challenging growing year for berry, to be quite honest. We've we've done well in some regions for a while and then we've fallen off in others. I guess the two material things to call out is that Arana volumes for us after probably a 3-year winning streak are going to come off a little bit. So we won't be hitting the forecast volumes that we had at the start of the season. And that's primarily due to some drop volume out of FNQ. And as you know, that Arana continually receives that price premium. So any volume, any tonnage we drop there hurts us a bit more than normal blueberries. So that's one part to it. The other part is, though, we're not just, as you know, a blueberry business, so we're a raspberry business and also increasingly a blackberry business. And we've got a small niche premium in strawberries. From a raspberry point of view, it's actually been a very steady year, so volumes have been in line and pricing has been good. From a blackberry point of view, we continue to see that segment grow, and we are really the dominant player in blackberries. And so we've got a lot of potential still for us in terms of blackberry going forward.
Okay, thanks for that, Sean. I'll hand it back to somebody else. Thanks a lot.
Thanks, Jason.
The next question comes from Ben with Jarden. Please go ahead.
Good morning, guys. Just the first one from me. Sorry, I'm going to ask the questions, John, is the makeup again, but just on what you've given us. So just in terms of to think about the let's call them one-off type costs, because obviously in the PCP, the first half, you probably had close to $20 million of one-offs, if you like, around drought and COVID. So this year, in terms of the first half, what we should think is sort of one-off or sort of out of your control was the fruit fly, which I think you said is 6 to 8, and then the hail damage impact, which we can make our own estimations on. Is that sort of the two explicit ones that we need to think about?
Yeah, I think depending on how you define one-offs, Ben, we would say that avocado industry volumes, including our own, are certainly having a bumper year. And in general, with that much energy being put into the fruit, we wouldn't expect the industry volumes and our own to replicate that next year, but we'll obviously have to see how that plays out. Certainly factually, as you know, avocado pricing has been at previously unreported lows. So we would hope that we're not going to see that again next year, but I think that other than that, you've hit the main things.
Yeah, because it's not like we're going to see, because avocado prices obviously wholesale level down 60-70% at the moment. Would you expect, I suppose, given the life cycle, 6-7 year maturity before they start yielding some reasonable amount, you'd think pricing, or if you've got any visibility that pricing should start to tighten up, because it still seems pretty depressed even just looking at last week's pricing.
Yeah, well, I mean, the key elements this year for the pricing are plainly what's happened out of FNQ and CQ, where not just us, but the entire industry had really, really big volumes. And now WA season is predicted to be a sort of 9 million tray. To put it in perspective, I think this year the Australian market, overall industry market, will bring to market about 25 million trays, and that's versus about 16 million last year. So that's a massive jump. The backdrop of the growing tree maturity, yeah, we've all known about that, and we've talked about it many times in meetings with the market. So it's going to be lumpy, but definitely volumes are going to keep increasing. However, up until now, demand and consumption has kept pace with that. Now, what we do know is with the COVID lockdowns, particularly the entire food service sector has suffered big declines. And of course, the volume that would have normally gone there has ended up in major retail, which has further added to price depreciation. So I think from our point of view, of course, we're optimistic about the avocado segment. One of the reasons for bringing it together with citrus into trees and vines is we see the future for avocado as obviously much more export-oriented, and we're doing a lot of work around that. Domestically, we'd hope that with the food service demand getting back to normal levels, that'll take some heat out of the retail market. And then we'd expect to see from an industry point of view, let's say a more normal, not quite the on-off year of citrus, but more of an on-off year type arrangement that you'd see from those trees.
Right. And just in the second half, just on the mushroom side again, are you expecting, or is Monarto now moving to nameplate on a week-to-week basis, and are you getting that $1 a kilo type efficiency benefit through? Now you're saying the labour issues have resolved.
Yeah, we've always got that efficiency benefit. And to be really frank, the reason I'd like to take the conversation up a little bit from Monarto is there's no doubt you can talk to any mushroom producer in the country. Mushroom facilities, by their very nature, are a bit up and down, and we're talking within the margin of sort of 10%. So all of our facilities have that. Mushroom, Monarto, of course, because of the capital investment we've talked to pretty steadily now for just over 2 years. But at the end of the day, what we've really got to focus on is across the group of our 3 facilities, and we're the only sort of multi-site operator. We've got to grow our volumes there, and crucially, we've got to get all of them onto a lower cost basis. So that's really what we're going to focus on. You'll see the volumes at a cumulative level again at the end of the year, second half, and then you'll have a really good eye on the entire year for comparator.
Yeah, no, that's fair. I suppose it's just from our perspective, it was obviously a big capital investment and big expectation and uplift, and obviously hasn't come through in the first half. So I suppose just understanding as we think about that step change in the second half.
No, it's fair, Ben, and I've always talked to it, right? Like that's the thing I've probably the most, right? But we're getting the labour cost efficiencies that we wanted. We've got the better cost position. We just need to bring more production to market, really across all 3 sites.
Yeah. Okay. No, that's helpful. Thanks, guys.
Thanks, Ben.
The next question comes from James Ferrier with Wilsons. Please go ahead.
Morning, Sean and Wayne. Thanks for your time. That international result was a cracker. I'm just wondering, in the second half, typically that business sort of more cost-heavy, less revenue, it's typically loss-making. With the early revenue out of China, do you expect that the international segment would see the loss increase year on year as the business grows, or does that early season China revenue sort of buffer that and that loss sort of stays similar year on year?
Yeah, it's Wayne, Joe. Thanks for the question. Clearly we're increasing our footprint, so the cost of the farming production go up as the footprint gets bigger, particularly given the second half where there's no revenue. But I think that increase in footprint will be largely offset by a little bit more revenue in December generally when China starts to come in. But I don't see a material change from previous years in relation to that delta between first half and second half.
Okay, that's good colour. Thanks, Wayne. Second question, just a point of clarification around the fruit fly impact, $6 to $8 million. Just Sean, your answer to Ben's question, I was a little bit confused there about whether that's a first half impact or whether it's actually across the season. And I mean, typically the Riverland production would be second half skewed, so that cold treatment, I would imagine, would have a second half skew. Is that, have I interpreted that right?
You have, James, and apologies if I made it confusing. But yeah, that's a seasonal estimate for citrus.
Yeah, okay. Wayne, I was furiously trying to write down some of your comments there on second half CapEx and D&A. The D&A in particular, I think I recall you talking sort of more closer to 110 for the full year at the last update, and this first half number didn't increase by much. So is that 110 now looking too high?
Look, yeah, that's a call out we made in, I think, May, and confirmed that again in June. So we are expecting certainly an increase in run rate in the second half. Maybe a touch higher than I thought. I mean, it really comes down to, given the extent of the programs we have and the timing of when they do actually become in production, and then when obviously the DNA starts to click in, it can move around. But I think 110 would be worst case, and I think maybe slightly lower, but it's certainly around that level. And particularly then moving into next year, that obviously that run rate I'd expect to continue in the second half next year. The first half next year and second half next year. And then in addition to that, we've obviously got the acquisitions we've made this year, so we'll see some additional DNA from the 2PH business, and to a lesser extent from the Select Fresh business.
Yeah, thanks. And did I hear you right? 25 maintenance capex, 55 growth capex in the second half?
Yeah, that's right. Yes.
Okay. And any colour you can give us on the tax rate, second half?
Yeah, it will be a slightly higher rate because of the mix. So obviously we have with no international earnings, so the favourable effective rate sort of moves closer back to the 30 rate. But I guess what I'd probably based on the guidance we're giving you on the full year EBITDA number and NPAT number, if you double the number for the first half, you're going to be pretty close.
Yeah, okay, that's helpful. Last question from me for Sean, maybe. Can you just give us an update on where Costa is at with the Vital Harvest assets and the new landlord, particularly around the likely rent expense, cash rent expense under a new agreement, and also if the agreement is extended, what the impost would be around ASB 16?
I'm actually going to let Wayne handle that one too, James.
Yeah. Thanks.
That's why I threw it to you, Sean.
It gives me the harder one.
Yeah.
Obviously Macquarie now in control. I think change of control passed over late June. We're yet to agree the final terms of the new lease arrangement, but as we previously disclosed, we have a framework for that agreement, or what that leases may look like, given we signed a lease implementation deed, I think about November, December last year. And the key components of that are, as we announced, is that we're moving away from a fixed variable arrangement to a solely fixed rent, but also additional tenure, with giving us 20 years from the date of signing the new leases. So at this stage, James, I can't give you the quantum of that, but when we do sign those leases, given the materiality, particularly on the group's balance sheet, we'll make a statement to the market. But I think previous statements I've made, the balance sheet's likely to gross up by close to $250 million, given the large lease tenure, 20 years. But we're not in a position yet to talk about what the P&L impact will be on the group.
Yeah, okay, understood. Thank you both for your time.
Thanks, James.
The next question comes from Alex Patton with Citi. Please go ahead.
Good morning, Sean and Wayne. Just a couple from me. Just looking for some clarity around the potential 2PH contribution this year, and how we should expect that to come through, and how you might present it at the full year results.
Yeah, it's Wayne. I'll take that question. As per, I think, the statement Sean made in the presentation, we have, as part of the acquisition, not only do we obviously get the sales activity post-completion, but we basically took on the season. But I guess through the quirks of the way that Sagara accounting and also the requirement for acquisition accounting, it's likely that the contribution from a statutory perspective, so post Sagara, will probably be minimal on the group, largely because we've commenced, or I guess the season, 2/3 of the way through the season. So from an accounting perspective, a lot of the fruit that we've bought, we need to fair value, and that fair value will probably approximate what we sell it for. So that from a statutory perspective, I guess the point being that we don't see a major contribution from 2PH this season. The other one is the harder one, which is the EBITDARS, or the pre-Sagara accounting. We're still working through that. But as I said, once we have greater clarity around where we finish the season, particularly around final pricing and total yields, we'll be able to give the market a bit more update later in the year. But it's certainly from a point of view of what we've seen to date. We've been on the farm for about 4 weeks now, 4.5 weeks. I mean, in line with our expectations. We made the statement that if it had been owned from day one of the calendar year, we would have expected the EBITDARS to be around $29 million, and that's the same as we put to the market on the day we announced the acquisition. So everything's been in line with expectations. But I guess through the quirks of the accounting, as I said, not a significant contribution from a statutory perspective, but there will be a big contribution from EBITDARS. But at this stage, I'd rather reserve my comments until I have greater clarity this season.
Sure, no worries, Wayne. And then just on Glasshouse 4, what kind of volume uplift should we be expecting during its first year of operation, and how long will it take to kind of ramp up to, I guess, normal yield levels?
Yeah. So thanks for the question there. Just on Glasshouse 4, so if I just step back from it for a second, it's a 10-hectare glasshouse, and 5 hectares of the volume that will be growing there is volume that used to be supplied to us from a third-party grower. So we're in-housing that. And then the other 5 hectares, we're looking at circa 3,500 tonne once fully operational, which will be from the beginning of CY22.
Got it. That's very clear. Thank you.
Thank you.
The next question comes from David Pobucky with Macquarie Group. Please go ahead.
Good morning, Sean and Wayne. Thanks for taking our questions. Just picking up on that previous 2PH question around being 2/3 of the way through the season. Was that at the date of the acquisition?
Yeah, roughly that day. I mean, it's March through September, October, the season, but there is a heavy weighting towards the second half, particularly the Murcott variety, which is the last of the varieties to be picked and sold. So it is if you think about the revenue split, it is a bias towards the second half, and given the accounting on the cigar, therefore the earnings would be biased towards the second half. But yeah, it's sort of roughly those sort of numbers.
Thanks, Wayne. And just on avocados, 50% lift in industry volume, and Costa's volumes up only 15%. Are you losing share in avocados? And then second point to that, what's happening to the excess production? I mean, is a large part of it going to the export market, or is it just flooding the domestic market?
Yeah, I think two things on the domestic market, David. Yeah, most of the volume you'd have to assume is still going domestically. We're probably one of the leaders from an export point of view, but the trays that we export are still relatively minor compared to the amount domestically. Further exacerbating that, and I think as I said before, is the fact that food service, hospitality is really shut down, so any volume that would have been going there is probably also ending up in retail. I guess this year we would have dropped a bit of share, but what's actually happened is our northern New South Wales region was subject to the major flooding that you may recall, and we've had fruit drops from that region that are fairly significant to us within that region. So we've had less volume coming out of there. I think if we step back, and it's a good question, and I'll check it, but if we step back and just look at the other two regions in light of what's happened from the industry, and I don't see us as losing relevance in the Australian market or dropping share.
Thank you. And just one last one from me, for Wayne. I know you don't report this way anymore, but are you able to indicate what the lease impact was on EBITDA and NPAT in the first half? And I suppose if you can't quantify, I mean, was it broadly similar to last year?
Yeah, I actually don't have it in front of me because we've totally moved away from that. So so apologies, but it's not a number I keep. Yeah.
Okay, thank you very much.
There are no further questions at this time. I'll now hand the conference back to Mr. Hallahan for any closing remarks.
No closing remarks other than to say thank you to everybody who came on the call, and look forward to discussing our results further. Thank you.
This concludes our conference for today. Thank you for attending. You may now disconnect.